Welcome to the Explainer. Let's just dive right in, shall we? For nearly a century, professional financial advice was entirely locked behind this velvet rope. If you didn't have $500,000 sitting in the bank, Wall Street literally did not care about you. Best case scenario, you got a glossy pamphlet and a savings account paying practically zero. But in 2010, the doors blew wide open. So today, we're going to crack open the black box of Robo-Advisors to see exactly how algorithms have completely democratized Wall Street math. We're stripping away all those confusing marketing buzzwords to explore the actual mechanics powering over $1 trillion in wealth and how you can use them to take control of your financial future. Here is our quick roadmap for today. We'll start with the Wall Street velvet rope, then go inside the black box, followed by comparing the big players, looking at the behavior gap, and finally wrapping up with the cyborg advisor future. All right, Section 1, the Wall Street velvet rope and the 1% problem. It's really crucial to understand just how heavily the deck was stacked against the average person before the year 2010. Back then, a staggering 80% of Americans were completely locked out of professional financial advice. A traditional advisor demanded a $500,000 minimum just to let you open an account. And then they'd charge a 1% annual fee to cover their heavy overhead, stuff like fancy office rent, staff, and golf meetings. But then the robo-advisor model came along and completely flipped the script. We're talking a tiny 0.25% fee, absolutely $0 minimums, all seamlessly powered by automated algorithms. $134,000. Yeah, let that sink in for a second. That is exactly how much money a 1% traditional advisor fee drains from a standard $100,000 portfolio over 30 years, especially when you compare it to a robo-advisor charging just 0.25%. I know that 1% might sound kind of tiny up front, but compounded over decades, it's a life-changing amount of money that you lose simply to pay for someone else's expensive office. Moving on to Section 2, inside the black box, 70-year-old math, not sci-fi. So how exactly do these automated platforms replace the expensive human? Well, spoiler alert, the whole AI marketing pitch isn't actually sci-fi at all. Turns out there is no robot day trading your account. Instead, the core of every single robo-advisor is modern portfolio theory, or MPT. This is a 1952 Nobel Prize-winning strategy created by Harry Markowitz. It mathematically proves that you really don't need to pick winning stocks to build wealth. Instead, diversifying your assets and constantly rebalancing them absolutely beats stock picking over the long haul. Human advisors used to charge you 1% to do this manually. Actually, scratch that, a lot of them still do. But robos, they just do it with code for a fraction of the cost. When you sign up, your personal risk score dictates your allocation. For example, if you have a moderate risk 6 portfolio, your money is automatically split up. 54% goes into a U.S. total stock ETF, 36% into international stocks, 7% into U.S. bonds, and 3% into real estate. And this specific mix isn't just random guesswork. That 1952 math dictates that this exact allocation gives you the absolute best return for that specific risk level. When stocks crash, bonds often rise. The assets essentially zig and zag, smoothing out all the turbulence of the market for you. But the mechanics don't just stop at buying ETFs. They also do tax loss harvesting. This is a brilliant strategy wealthy folks have used for decades. Basically, if you own an ETF that drops in value, the robo-advisor automatically sells it to book a loss and instantly buys a similar but not identical ETF to maintain your market exposure. That booked loss then offsets your taxable gains elsewhere. Wealthfront clients, for example, save an average of 1.5% per year doing this. A human CPA is usually way too expensive to do this daily for a small account, but an algorithm, it just scans for these tax-saving opportunities every single day for pennies. Okay, Section 3, comparing the big players. Who actually gets your money? The underlying map absolutely works, for sure, but which platform should you actually use? When deciding, keep in mind that they all use very similar ETFs, so your returns are going to be virtually identical. The real differences lie in features and fees. Betterment was the very first robo-advisor. With a $0 minimum, great goal-based interface, and integrated banking, it's hands down the absolute best place for total beginners to start. Next up is Wealthfront. They require a $500 minimum but have incredibly advanced tax tricks like direct indexing. It's totally the perfect platform for tech-savvy nerds with slightly larger accounts. Finally, we have Vanguard Digital Advisor. They require a $3,000 minimum and honestly have a pretty boring interface, but they offer the absolute cheapest fee at 0.15%. That makes it perfect for no-frills, die-hard bogleheads. Now, a quick heads up here. You might see platforms like Schwab or SoFi advertising a 0% fee, but beware, 0% fees are almost never actually free. I mean, they gotta make money somehow, right? Schwab, for example, will hold a large chunk of your portfolio, sometimes up to 30%, in pure cash, earning terrible interest rates. That cash drag acts as a sneaky hidden fee that can actually cost you more than just paying the straightforward 0.25% fee at a place like Betterment or Wealthfront. Always check the fine print. Which brings us to Section 4, the behavior gap, protecting you from you. Honestly, this might be the most crucial part of the entire explainer. Morningstar data reveals a massive issue. Over a specific period, allocation funds returned a really solid 7.7% per year. But the actual investors in those exact same funds, they only walked away with 6.2%. That missing 1.5% every single year is what we call the behavior gap. Because humans are emotional creatures. When the market is soaring, we get greedy and buy high. When the market crashes, we totally panic and sell low. You can literally have the best, cheapest, do-it-yourself portfolio in the world, but if you panic during a crash, you completely destroy your wealth. And that right there is the true superpower of this tech. Sure, it's a math tool, but more importantly, it is a psychological lockbox. It actively blocks you from day trading. It entirely removes those big red sell everything buttons. Betterment even goes as far as hiding your daily returns from the main screen so you don't obsess over normal market dips. Vanguard actually found that their robo-clients were 3 times less likely to panic sell compared to DIY investors. Paying a tiny 0.25% fee to stop yourself from making a 40% panic mistake is literally the cheapest insurance you will ever buy. All right, Section 5, the cyborg advisor future, what AI just can't do yet. Because let's be real, automation isn't perfect for everyone forever. Just consider this sentiment. Market crash, I'm terrified. An email from a bot is not a human voice. When the market absolutely plummeted back in 2008, human advisors earned their 1% fee simply by talking their clients off the ledge on the phone. An automated email from a robot saying stay the course simply lacks the genuine human empathy required when someone is experiencing deep, real-world financial panic. And, empathy isn't the only limitation here. A robot simply doesn't know how to handle complex, messy life events like divorce planning, navigating estate mapping, or managing Medicaid if a parent gets dementia. If you receive complex company RSUs, or want to buy real estate, or need grief counseling because a spouse passed away, the algorithm totally fails. Robos do portfolios, not people. That is exactly why the future of advice isn't purely robots. It's a cyborg hybrid. AI will run the boring math, and a human advisor will step in for the complex life events, likely for a combined fee of around 0.30% instead of that old chunky 1%. But if you're among the vast majority of us with just standard wealth building needs, your automated financial engine can literally be built in 10 minutes. Just pick a specific goal, like retirement 2055, to frame your mindset. Take the risk quiz and be brutally honest about how you'd actually react to a market drop. Link your bank to automate deposits. And finally, delete the app. Seriously, check it quarterly, not daily. Daily checking is a massive behavioral risk. So, you now understand exactly how $0 can get you Nobel Prize-winning Wall Street math. These platforms aren't magic. They're just 70-year-old wisdom made super accessible by code. So the real question is, are you ready to let an algorithm automate the boring 80% of your wealth so you can actually focus on the interesting parts of your life? Thanks so much for joining me for this explainer. See you next time.